Okay, good day audience and Assalamu alaikum. Today we will be doing inshallah question number 3 of March-June 2022 latest past paper. For your information, we have almost done all the questions now of March-June 2022. Question number 1, question number 2, 4 I have already taught, I have already recorded it, and now only one question was left, and that is question number 3 for March-June 2022. Let's do it. And it's a very good question, very scoring question. Many things they have given you from whatever we discuss in the class, right? Okay. The first issue is related to IAS 36. The very first issue is related to IAS 36. Okay. The second issue is related to IAS 12 and offsetting. And the third issue is related to IFRS 15, major related to IFRS 16 and IFRS 15. Okay, so things are controllable if you work out. Yes, we have our SBR WhatsApp group. You can contact me after the class. I'll give you the link. Okay, in the last webinar, we have sent the link of our group. Now let's start. Bohai company trades as a leisure travel and provides travelers with unique vacations. Okay, the financial year end of company is 31st December X8. So we basically provide cruise service or vacation service like this. We are in the tourism industry. Right? Now, the following exhibits available on the left hand side of the screen provide the information. Okay, now the first thing is impairment. Now, if I say this thing, it's totally correct. This scenario is related to the real life COVID thing. You remember, because of COVID, the biggest losers were tourism. Tourism industry was the biggest loser. Okay, so when demand suddenly dropped, so there are people in the world, they go for routine vacations, right? So because of COVID, they had to skip almost 1 year. So in the very next year, we saw abnormal demand of these things. That's why right now, if I'm talking about this current 2022, right now, the most expensive thing in the world is air tickets. They are abnormally high. Even I have one picture as well of inflation. So there are things which shooted up by 10%, 15%, but airline tickets went up by 49%. 49%, extreme high. Okay, so these abnormal behaviors are because of the COVID thing. So let's start. Bohai company has a portfolio of global cruise brands and a fleet of over 100 ships. Okay, so they provide like cruise services and all. At 31st December X8, as a result of global recession, the directors of Bohai assessed whether there was any indication that its cruise ship may be impaired, right? Simple. Just think, COVID was the biggest impairment hint, biggest ever impairment hint. Just think, because of COVID, we see the losses, we see our assets not working. That means assets not generating future cash flows. And when your asset does not generate future cash flows, so obviously the value in use will decrease. The VIU, value in use, will decrease. So your recoverable amount will go down, and yes, this is the hint of impairment. So now, the directors of Bohai company assessed whether there was any indication that its cruise ship may be impaired. The directors concluded that the ship should be measured at their carrying amount without conducting any impairment test. See, this is the wish of normally all directors or all accountants. Why? Because impairment is an expense. And impairment hurts. Impairment hits your P&L and your performance. So automatically, because of impairment, your profits goes down, your EPS goes down. So normally directors wants to avoid impairment. So that's what they are doing. But we have to fight with this director. We have to pick points from this question, and we have to prove that no, you have to do impairment testing. Okay, so now we have to pick the points. Now, the directors This is December 2022. This past paper is, sorry, this past paper is March, June 2022, question number 3. This past paper is, I have written here, see, March, this is March, June 2022, question number 3. Okay. It is available on your ACCA software as well. Now, the directors had highlighted several factors which were pertinent to the conclusion. They said, because of these points, we are not doing impairment testing. The directors are saying that because of these points, we are not doing impairment testing. Okay. Now, the first point, the price to book ratio. The price to book ratio calculated by dividing the market price per share by the carrying amount of the net assets per share was 0.3. See, your price to book ratio is 0.3. Wait. The formula is market price divided by carrying value of net assets. Market price per share divided by carrying value of net assets per share. And the answer is 0.3. Answer is 0.3 of this ratio. 0.3 means it's like 3 upon 10. 0.3 means, in other words, 0.3 means 3 upon 10. That means the carrying value of your net asset is $10, but the market price is just 3. The carrying value of your net asset is $10, and that means you are carrying net assets in your SOFP at $10, but the same net assets people are buying just for $3. So yes, this is impairment hint. This price to book value which is less than 1, this price to book value ratio which is less than 1, it's totally an impairment hint, because in our books we are reporting assets for $10. Just think, in our books we are reporting assets for $10, but those assets people are ready to buy just for $3. So yes, there is a defect. That means there is some bad news. So it's totally impairment hint. So this first point, my dear student, this first point itself is an impairment hint. So this goes with our favor, not that director favor. The directors were happy with this ratio as it was similar to other companies in the industry. That means other companies are also facing problems. That means the whole industry is facing the problem. And if you remember my lecture, of IS 36, if you have attended my IS 36 lecture, it is written, when the whole industry is booking impairment, like when the whole industry is thinking negative, you also have to go with the same. Otherwise, you have to give a big disclosure that why you are not following the industry practice. Okay. So this thing itself is an impairment hint. So yes, because of this point standalone, we have to do impairment testing. Now, there had been no losses from the disposal of surplus ships in X8, which were material in respect of X8 year financial statement. This is very, very, very stylish point. I love this point. They are saying we dispose of something, and we didn't get any loss on disposal. So it's okay. Wait, there is a possibility you bought those ships 10 years back. There is a possibility. Now listen to me very carefully. There is a possibility you bought that ship 10 years back and you are using cost model. You bought that some ships 10 years back and you are using, let us say, cost model. So now there is a possibility that because of that cost model and depreciation, the NBV is very low. But you sell it on a normal price. So yes, you will automatically get a gain on disposal. And this gain on disposal does not mean that the industry is good. This gain on disposal is because you used cost model. You bought things in past at a very cheaper rate, or you bought things for like 10 years or 20 years back. So this is not the argument in favor of director. This loss on disposal does not give any evidence that we should avoid impairment testing. This loss on disposal, see, they are saying there is no loss on disposal. There is no loss on disposal in this year. So this standalone point does not give any evidence, does not give any support that we should avoid impairment testing. Okay, why? Think over it. Think over it. Now you are giving your paper. You guys are almost chartered accountant now. Listen. Why there is no loss on disposal? No loss on disposal, because there is a possibility you bought many years back and you bought ships on a very cheaper rate. So obviously now NBV will also be very low. And when NBV will be low, so any price you will compare it with that NBV, the result will be a gain on disposal. There had only been an estimated 2% drop in the market value of the fleet in December X8. Now, their market value also went down by 2%. They are saying it's just 2%. It's just 2%. The directors had not engaged a qualified valuer to estimate the market value of the fleet, and this value was not based upon market transaction. Very, very excellent. 2 points. We can discuss IFRS 13 as well. See, first of all, they are saying that the market value went down by just 2%. They are saying just 2%. So we said, yes, it's down. Still it's down. And market value means fair value. So, you know, in impairment testing, whenever we calculate recoverable amount, there is one thing which is fair value. Recoverable amount is higher of value in use and fair value less cost to sell. Value in use and fair value less cost to sell. Value in use and fair value less cost to sell. So yes, there is a point of fair value in recoverable amount. So when your market value or fair value is going down by 2%, so this is again one of the hint of impairment. Okay, first thing. Second thing, they are saying it's just 2% down. It's just 2% down. So okay, we will say that you have not used the correct formula for measurement of fair value. You have not applied proper IFRS 13. They have directly used the measurement model. The directors had not engaged a qualified valuer to estimate the market value of the fleet, and this value was not based upon the market transactions. Just think, they have not taken the fair value from the market. And we all know that IFRS 13 clearly says that fair value is totally market based. Fair value should totally be now market based. So that means the fair value calculation is also wrong. 2 point. And the third and very important point, that impairment chapter is not only dependent on fair value. There is one more thing which is value in use. There is one more thing which we call value in use. So obviously, if the fair value is okay, if the asset fair value is okay, but if the future of asset is dark, if the future of asset or future earning power of asset is not good, again, there should be an impairment. Again, there should be an impairment. Okay, so you have to deal with this point, with these arguments, with all these arguments. The cost of fuel for the ships had fallen, and there was an increase in demand for cruising after a significant reduction due to a recession. Yes, I told you that the demand because of COVID, of the COVID, things went in waves. First, extreme low demand and then extreme abnormal demands, right? So because of COVID, you remember the cost of fuel went down. Because of recession, the fuel prices go down. Okay, so that's what they are saying. Bohai company has started negotiation with its creditor to defer payments of its debt. See, this is again a big question mark. What does it mean? That means our company does not have power to pay on time. Our company does not have power to pay the creditors on time. So again, this is clear. This is clear hint that our condition is not good. Our overall condition is not good. So this point also goes against the director view. Now, Bohai company had ignored the fact that several companies in the industry had written down the carrying amount of their ships during X8C. What is the industry practice? They have ignored. All other members of the industry, they have written down the carrying value of their ship. The carrying value, that means they book the other members of the industry, they are booking impairment. So when they are booking, why not us? When they are booking, when they accept that the conditions are not good, we should also follow the industry, right? This was as a result of many ships, including Buhai Company's ships, lying idle as a result of overcapacity due to the recession. So we have planned that we will only use some ships, because we will make some ships completely filled and we'll stay some ships at the dock, right? Now, even though the losses from the total sale of ships in Buhai Company were not material in the financial statement for the year ended 31st December X8, there were several cases where the loss relating to the disposal of a ship was 40% of the carrying amount of the ship. See, although for the overall financial statement, the loss is not material, but if we see individual ships, there is a 40% decline. There is a 40% decline in the value. So yes, again, we have to book impairment for these ships. So this point also goes against the director view. Now, the price of a cruise had not increased in 2 years, and therefore conservative income estimates had been applied in future budgets because of anticipated delay in the recovery of cruise market. See this point. This point will hit your value in use. This point will hit your value in use. See the word, read the word. They have openly used the word conservative income estimates. Conservative means prudent income estimate. That means they are not foreseeing some good things. They are not foreseeing some good news. When they are not foreseeing good news, that means the future cash flows are down. And when the future cash flows are down, your value in use is also down. And when your value in use is down, impairment is must. So there are many points. Which we discuss clearly shows that yes, there is impairment testing is must. I'm not saying impairment. Never ever say that do impairment. No, always in the classes I always use the word impairment testing or impairment review. Impairment testing or impairment. So yes, impairment testing or impairment review is must. On the basis of all these points, impairment testing or impairment review is must. One point which I would like to highlight as well, that when they are saying about the competitors in the same industry, other members in the same industry. So one very, very simple point, that whenever you see the ships or assets of other members, don't forget to compare the age quality of the assets, that when did they buy and how much they are depreciated, to make the comparison like with like. Okay, right? Because sometimes we do this mistake. We compare new assets with old assets, or we compare old technology assets with new technology assets. So that comparison is not like with like. That comparison is not like with like. Okay, so did you get these points? Please comment on the chat box, please, if you got these points. These points were normal part of your classwork. In the class you also discuss such things. At least these are not new points. Now just simply go see the requirement, and then I'll show you my solution with the headings. That's not difficult now for you. And don't be dependent on spoon feedings now. See, this is the requirement. Discuss whether the directors of Buhai Company were correct in not conducting. They see that what was their point of view. Their point of view was that they didn't want to conduct impairment test. And impairment testing at 31st December X8, it's 9 marks. Big question, 9 marks. Okay, so please check it out. It's in front of you. In the first point, see there, it's written IS 36 says never ever book impairment directly. Always you need to do impairment testing first. And when you do impairment testing, tell me, when you do impairment testing, when you get the hint, whenever you get the hint of impairment, whenever you get the indication of impairment, you do impairment testing. So now we have to prove in this question, that there is a clear hint of impairment. There is a clear hint of impairment. Okay. In the next line, they are simply telling you how to calculate, how to do impairment testing, like we do recoverable amount, like we calculate recoverable amount. Okay. Then we have application, and then we have a lot of arguments. The application number 1 is related to price to book ratio, which I have already explained. Price to book ratio is less than 1, it's 0.3. Price to book ratio is less than 1, it's 0.3. So again, this is clear hint of impairment. This is hint of impairment. Okay. Then application number 2, several companies in the industry, the other members of the industry have written down their carrying value. So when they have written down their carrying value, so it means that we are not following the industry. But yes, again, when you compare it with other parties, you must see the age, and type of assets and technology of assets. Then Bohai company, see the application number 4. Bohai company mentioned that there had only been 2%. Remember the 2% drop. Remember the 2% drop. 2% drop. So see the arguments. First of all, the market value. Only the change in market value is not the indicator. Only the change in market value is not the indicator. There is one more indicator, which is value in use. And also they have not done correct fair value calculation. Okay. So please just walk through this. You will understand. I've already explained you all these points. Walk through it. And in the end, we have to conclude that yes, impairment testing is must. Impairment testing you can't avoid in such a situation, because lot of points against the directors. Now let's move. Please check the application number 6 as well. Please check the application number 6 as well. Yes, in application number 5, my dear student, they are saying that because of recession, the price of ship did not increase for 2 years. So that's why they are not enforcing any good things. You remember in the question there was a word conservative income estimates. Conservative means prudent. That means they all are expecting less in future. And whenever you expect less in future, so automatically your future cash flows will be lower. And whenever your future cash flows are lower, your value in use will be lower. And yes, this is the hint of impairment. This is the hint of impairment. Now, next area we have is IS 12, related to IS 12 and offsetting. IS 12 and offsetting. Now wait. When I teach in my normal class, when I teach financial instrument, I always teach the one topic which we called offsetting. Offsetting means cancelling receivable and payable. For example, I have to receive a certain amount from you, and I have also to pay certain amount to you. I have to receive and also pay. So can I cancel my receivable and payable? Can I cancel my receivable payable? Yes, if we have legal and enforceable right. If we have legal and enforceable right. What does it mean? It means there is an agreement, and that agreement clearly says that we can do net payment. Agreement clearly says that I can cut your money and I can pay you remaining amount. For example, I have to receive 100 from you and I have to pay 150 to you. So the agreement clearly says that I can pay you 50. The second point is the parties must be same. Parties must be same and dates must be same, right? That is the payment on net basis. That is the payment on net basis. So if you meet these strict conditions, then only you can offset. Then only, very good, very good. Some students are doing very good comments. They are even giving me logics. Very good, excellent. So my dear student, if you meet offsetting criteria, then only you can offset. Otherwise this is a big crime. Even in audit firms. If you see audit firms, so partners sometimes involved in these type of transaction. They strictly don't allow to offset because of wrong offsetting. Because of wrong offsetting, you can hide the risk. You may hide the risk of the organization. And one more thing, I'll send you guys one vlog. I made one vlog on bike. I made one vlog of setting, but that's in Urdu Hindi language. I'll send you. So those who understand this language, they can watch it. It's very, even I told one personal story of my life related to offsetting. I'll send you on your WhatsApp group. Let's start. Now listen. And before we start, one more thing, on unused tax losses, do you know the meaning of unused tax losses? All of you must know this, unused tax losses. Listen, whenever you earn gains, whenever we earn profits, so tax department charges tax from us. So on income we match tax expense. With income we match tax expense. But with losses, when we are in bad times, tax department gives us relief. Okay, now look at here. Listen, for example, we have a loss this year. So when we go to tax department with the loss, the tax department will say us that you can carry forward this loss, and you can cancel this loss in front of future taxable profits. So this simply means this unused tax loss will give us benefit. So yes, now we can book a deferred tax asset in front of this unused tax losses. Okay, because we need to match the benefit now. We need to match the tax benefit now. And we all know deferred tax is the application of matching principle. So with losses we match the deferred tax asset benefit. Okay, one more thing. When I teach in class deferred tax, I always emphasize on the matching. Even I move my fingers, matching. Like, for example, listen here. Let me show you one example. For example, we have this entry, dividend receivable debit 10,000 and P&L credit 10,000. We have this entry, dividend receivable debit 10,000 and P&L credit 10,000. Dividend receivable debit 10,000 or P&L credit 10,000. Okay, now when you go to tax department and you will say, please take the tax on this dividend income, they will say no. As you will physically receive the dividend next year, so tax department says, okay, pay in the next year. But we have to apply matching principle, so we book now. Let us say 30% is the tax rate. So we'll make the entry P&L debit 3,000 and DTL credit 3,000. Okay, P&L debit and DTL credit, and now see the matching, all of you. See, this is PNL and this is PNL. PNL matching. As the first entry goes in PNL, so that's why deferred tax effect will also go in PNL. The first entry is in PNL, so second entry will also go in PNL matching. But if the first entry is an OCI, so second entry will also go in OCI to match. Hope you remember the topic deferred tax on revaluation. Hope you remember the topic deferred tax on revaluation. Hope you remember the topic deferred tax on revaluation. My dear students, we all teachers teach this topic in detail with total energy. Do you remember this thing? Please comment. All of you, please comment. Don't sit idle. Okay, good. Thank you. Now, let's move to the question. Deferred tax asset describes the accounting treatment of deferred tax assets on 1st January X8 and 31st December X8. Now, don't sleep. Only one question today we have. Please do with focus. Bohai company applied the expected ECL, expected credit loss model in accordance with IFRS 9 financial instrument for the first time at 1st January X8. Now go slow. Students, you remember that whenever we apply a new IS, so there are some IS, they say to apply it retrospectively. There are some new accounting standard and they order us to apply things retrospectively, right? Whenever a new IS came. As a result, the ECL model had a negative impact on opening retained earning, as Bohai company correctly applied the impairment model retrospectively. Okay, so as we applied this new standard correctly but retrospectively, so we went in the past and in the past we booked impairment. In the past we booked impairment. So when in the past we booked impairment, so definitely our past profits went down, and when your past profits went down, your opening retained earning will automatically go down. So that's what they are saying. There is a negative impact, there is a bad impact on opening retained earning. Okay, right? So just think, let us say this negative impact, this impairment created losses. This impairment obviously will create profits down or losses. So let us say tax department also agreed with us. Okay, we'll allow you. Tax department said, okay, we'll allow you tax benefit against this. We will allow you tax benefit against these losses. So automatically we have to book deferred tax asset. On these losses. Now read. Therefore, a deferred tax asset DTA was, please look at the screen, was recognized of $25 million because of increased tax losses. The recoverability of DTA was based on future budgets. Okay, so there is no problem. DTA means deferred tax asset. There is no my dear student, there is no problem with DTA. DTA is perfect. This topic is not about the future issues and all. DTA is perfect. Okay, now as at 31st December X8, there was a change in the ECL allowance. ECL means expected credit loss. That means impairment allowance. And as a result of, Bohai company increased the amount of DTA assessed as recoverable from 25 million to 30 million and recognize an increase in DTA of 5 million in the profit and loss. Now go slow. Just read this paragraph again. I'm not saying anything. You read this paragraph again, please. Listen, very simple, very simple. Go simple. It is written in IS 12 and it is taught to you in classes that normally almost every year there is some change in deferred tax asset or deferred tax liability because of the new information. Because when 1 year passes, we get new information. Because when 1 year passes, we get new information. So now we need to revise our deferred tax asset or deferred tax liability. So this revision or this changes in deferred tax asset or deferred tax liability is adjusted prospectively because there is a new news. There is a new news, right? Something new, change in the estimate, change in the information. So this change in the information is always adjusted prospectively, right? So that's what they are saying, and they are saying from this 25 to 30. See, this 25 to 30, this 5 million we have booked in profit and loss. So do you think it's correct? Yes, it's correct. It's absolutely correct. Wait. As the first of all, initially we booked how much? Initially, how much was the deferred tax asset? The initial deferred tax asset was 25 million, and that created because of retrospective transaction. That created because of retrospective transactions, and retrospective transactions are adjusted in opening retained earning, which is equity. Retrospective transactions are adjusted in opening retained earning, and opening retained earning is the part of equity. So use your brain. When your starting deferred tax asset was created because of equity, so the deferred tax asset portion will also go in equity because we need to match. But in this post period, in this current year, we booked more impairment. And you know ECL, you have studied ECL, you have studied expected credit loss. And in expected credit loss impairment accounting, we book expenses are in P&L. So now when this year things you have parked in P&L, so the impact of deferred tax asset will also go in P&L. So this is totally correct. This is totally acceptable that from 25 to 30, this 5 million should go in P&L. This is totally absolutely correct because the issue is matching principle. Okay, so there were two assets. The first is 25, which is created because of retrospective transaction. The 25 million was created because of retrospective transaction, and yes, the retrospective transaction affects your opening retained earning, which is equity. So initially the transaction was booked in equity, so deferred tax impact will also go in equity. Deferred tax impact will also go in equity. Okay, but in this year, as we have booked the impairment in P&L, as we have booked the impairment in current year P&L, so deferred tax asset will also go in P&L. Are you getting? Let me show you the entry. This is the entry. See, the entry of deferred tax asset is like this: DTA debit and P&L credit. This is the entry. Okay, DTA debit and P&L credit. DTA debit and P&L credit. Okay, DTA debit and P&L credit. Right? So this was the first part. This was the first part of this issue. Now the second issue is offsetting. See, Bohai company has a subsidiary Yuan company, which has a deferred tax liability of 10 million. Now wait, we are parent company and there is a subsidiary has deferred tax liability. Bohai company has a legally enforceable right to offset its own tax assets and liabilities. See, this is very important. This is very, very important. Let me highlight. We are Bohai is parent. Bohai company is parent companies. Read the line. Bohai company has a legally enforceable right to offset its own Own means only parent companies. If parent company has deferred tax liability and deferred tax asset, yes, parent company can cancel. Parent company can cancel, but parent company cannot cancel the deferred tax liability of subsidiary with its own assets, with its own deferred tax asset. That's not allowed. See, there is no legal and enforceable right with subsidiary, but not that of its subsidiary. The directors of Bohai company have decided, as Yuan company is located within the same taxation jurisdiction as Bohai company, they can offset the deferred tax asset of 30 million against Yuan's deferred tax liability of 10 million. Absolutely wrong. Absolutely not. Absolutely not. You guys tell me before starting this question. I told you what? I told you offsetting. For offsetting, the first condition is legal and enforceable rights you have. The first condition of offsetting is legal and enforceable rights. So my dear student, they are openly saying that parent company has no legal and enforceable right to cancel the deferred tax liability of S company and deferred tax asset of P company. They can't do it. That is not allowed by tax department. That is not allowed by tax department to set off on group basis, to offset on group basis. Okay. Although there is only one tax authority. Although, see, they are saying that within they are located within the same tax jurisdiction. They are saying we are located in the same tax. It's not enough. It's not enough. If you want to cancel assets and liabilities, deferred tax assets and deferred tax liabilities, the tax authorities should be same. And the most important thing is you have legal and enforceable right. And what does it mean? That it is written in the document, the tax department allows you to settle the net liabilities, for the whole group, Okay. Let me tell you one extra thing. In UK tax, our P6 teacher, Sir Wes Mirchawala, few months back, we were discussing some issues. So he told me that in UK tax now there are some availability of group taxation. Like the whole group can pay one tax. I'm talking about the corporation tax. I'm not talking about value added tax. Okay. The whole group can pay one corporation tax, but that's the discussion was for the scope of UK. And right now we are doing international paper. Right now we are doing SBR international. And in the international paper, we have to see the tax issues in the question. In the question, everything will be written. In the question, everything will be written, my dear students. And in this question, they are saying we don't have, in this question, we are saying we don't have legal and enforceable right. Okay. So quick two issues. I know I took more time. By repeating it. So quick two issues. The first thing is about the retrospective matching and current year matching in the PNL. Current year matching in the PNL, retrospective in equity. And the second thing is offsetting is not allowed here. Offsetting is not allowed here. Let's walk through the debrief, please. Check it out. IS 12 income tax sets out the principle of that accounting for the deferred tax effect of an event should be consistent with the accounting event itself. Yes, this is called matching. If the principal transaction going in PNL, deferred tax will also go in PNL. If the principal transaction is in OCI, deferred tax will also be parked in OCI. Very simple, I told you. Now, the criteria in other comprehensive income to be recognized in other comprehensive income. That means if the principal transaction is going in other comprehensive income, your deferred tax will also go in other comprehensive income. See, directly in equity, recognize directly in equity. If the principal transaction is in equity, deferred tax will also book in equity. Same thing which I told you. Now, IS 12 explains that IFRS standard require or permit particular items to be credited or charged directly to the equity, such as the adjustment to the opening balance of the retained earning resulting from a change in accounting policy, which is applied retrospectively. Yes, we know that whenever there is a changes in accounting policy, changes in accounting policies are adjusted retrospectively. Yes, and retrospective means opening retained earning adjustment, and opening retained earning itself is an equity transaction. However, such accounting treatment does not necessarily extend to the subsequent adjustments to the deferred taxes of 5 million in December X8 originally recognized on 1st January X8. Okay, that means only the part of 25 million, the opening part of 25 million which generated because of retrospective application. The 25 million deferred tax asset was created because of the retrospective application. So that will only go in equity. But this current year thing of 5 million, this current year thing of 5 million will definitely go in P&L, because the current year impairment ECL losses, are going in P&L. Also, where the IFRS 9 financial instrument expected credit loss model is applied, all impairment charges are recognized in profit and loss. They are talking about the current year. Which is December X8, Therefore, it is acceptable to recognize the additional deferred tax asset in profit and loss. Okay. So the opening 25 million should go in equity, but the further 5 million should go in P&L. Very simple. This is the same thing which I told you when we were doing the question. Now, this is the offsetting issue. The next issue is offsetting issue. Deferred tax assets and liabilities must be recognized gross, that means on actual amounts, unless the entity has a legally enforceable right to set off the current tax assets and current tax liabilities, and the deferred tax assets and deferred tax liability relate to the same taxation authorities. See this. What does it mean? It means there are two conditions. In this paragraph, I have discussed two conditions. Number one is legal and enforceable right, and number two, same tax authorities. Legal and enforceable right and same tax authorities. Okay. So yes, we have the same tax authorities, same tax jurisdiction. It was written, but there is no legal and enforceable right to offset with your assets and your subsidiaries liabilities. There is no. This is only the case where the above relates to the same taxable entity or different taxable entities which intend either to settle taxation on a net basis or to realize the assets and settle the liabilities simultaneously. Net basis means payment on same date. Payment on same date. Okay. So it means net basis means payment on same date with the same party, plus you have the legal and enforceable right, and the legal and enforceable right is missing here. Legal and enforceable right is missing here. This is the problem. So now what will be the conclusion? Read it. As the deferred tax asset and liability of Bohai Company and Yuan Company do not relate to same taxable entity, the directors of Bohai Company must consider whether these entities either intend to settle current tax liabilities and assets on a net basis or to realize the liabilities simultaneously. They should first make the plan of this. This will generally not be the case unless Bohai Company and Yuan Company are part of a tax group, which I told you of P6 things, that if if in their country, there is a group parent and subsidiary, if tax authorities allow to make a group, and if tax authority allows you to settle on net basis, if tax authorities allow you to make a group and tax authorities allow to settle taxes on net basis, then only you can do. Where the local tax jurisdiction allow a group of companies to file tax return on a consolidated basis. See, this is all the context. Therefore, Bohai company should not set off the Yuan company deferred tax liability in the consolidated financial statement. So the biggest problem with this offsetting issue, tell me, there was no legal and enforceable right. Okay. And that's why there was no tax group, because the tax authorities didn't allow them to settle taxes on group basis. No such thing was written in the question. That's why we went against this point. To offset. Okay. Can anybody tell me which IS we study this offsetting? Can anybody tell me which IS did we study offsetting? Yes, IFRS 9. In IFRS 9 we discuss IFRS 9 financial instrument, we discuss offsetting conditions, and we discussed it with reference to receivables and payables. Now, the last area is about IFRS 5. Now wait, do you know about principal and agent? Now wait, in your basic studies, like in FR level, you get these questions. Wait, let me just make up your mind. Once your mind is made up, you can easily do it. You know, when you are a principal, whatever you supply to the customer, that thing is under your control directly. And you directly supply to the customer. And in that case, you decide your own price, you decide your profit margins. All these things are in your decision. The price, the margins, the control of the goods are in your possession, and then you directly deliver it. Before delivery, the goods are in your control. So this is the case when you are principal. And you know, principal directly book the gross sales. In the income statement, and direct cost of sales, directly. Complete amount is the sales of principal. But when you are agent, listen, agent has very limited rights. One of the conditions are, before the delivery of goods and services, normally those goods and services are not in the control of agent. Agent just connect 2%. Two parties. So those parties directly provide services. To other party, and agent can just get the commission in between. That means if you are an agent, you cannot book the complete sales of principal. If you are an agent, you cannot book complete gross sales of principal and cost of sales. You can't do this. You can only book the commission. In your income statement. That's it. And once again, this commission is not like a margin. That means you don't have power to decide the price. You don't have power to decide the margins and price. You have restricted rights. So first, make up your mind. What is principal? Principal, whenever delivers something to customer, principal has the control before that delivery. A control of those goods and services before the delivery. But agent normally does not have control of those goods and services before the delivery, because agent connects 2%. Agent connects 2%, 2% two parties. Okay. Second difference, principal normally decides the price. Principal normally bears the risk. Principal enjoys the margin and price and all. But agent is just get his commission. He has normally no rights to decide the price and all. Okay. And normally agent has a limited risk. Agent has a limited risk as compared to the principal. And in the agent's books, we only book commission income. We only book commission income. Okay. Now, let's start. Giving you 2-3 minutes. Just give a quick read. Just give a quick read. The question is in front of you. I'm not saying anything. This is point number 3. You have to read it. I'm going to discuss in 3 to 4 minutes. Read it. Come on, read it. Okay. Describe the lease and non-lease components agreement with third parties. The business model of Bohai Company also includes the management and refurbishment of cruise ships. Income is generated by leasing cruise ships on operating leases to third parties, normally for a period of 5 years. Managing the cruise ships operations, non-lease element. Now, just think. First of all, just think we are lessors. We give our ships on operating lease to third parties. We give our ships on operating lease to third parties, right? Now, I have a question. See, it is written 5 years. Who can give me the answer? It is written 5 years. So it's more than 1 year. It's more than 1 year. Why it's operating lease? It's more than 1 year. Why it's operating lease? Can anybody answer? It's more than 1 year. Why it's operating lease? Any other answer? It's more than 1 year. More than 1 year, that is 5 years. Why it's operating lease? Yes, it's lessor accounting. Listen, this is not lessee accounting. No low value. My dear student, in lessee accounting, if a lease is more than 1 year, then it's going to be finance lease. And we book ROU and lease obligation in lessee. But in lessor accounting, we are lessor. In lessor accounting, still the old old conditions are used, still the old criterias are used. And now the life of the ship must be 20, 30, 50 years, and we have just given for 5 years. We have just given for 5 years, so it's a very nominal. It's very nominal as compared to the total life. Yes, IS 17, one student has said, still IS 17 lessor accounting used in IFRS 16. So no issue if it is 5 years, still operating lease possible. Because why? Because the life could be 20, 30 years. Original total life should be 20, 30 years. So it's okay. So first of all, my dear student, we are earning rental income. We are earning rental income because we are lessor. We are giving our ships on rent. We are earning rental income. The second thing, managing the cruise ship operations, they are saying non-lease element. Now, we are also giving other services like maintenance of the ships, like food in the ship, like cleaning services and other services. So this is non-lease element. This is not lease, non-lease element. And on non-lease element, now just think we are giving a service. We are giving a service. So just think we are doing servicing business. We are giving services, and or you can say we are earning from service business. So when you earn from service business, it's IFRS 15. You book IFRS 15 on the revenue transaction. Okay. So for leases, we'll apply IFRS 16, and for non-lease element, it's IFRS 15. Now it's very simple, not difficult. Gross revenue therefore comprises rental income. Yes, rental income that the tenant or the other party lessee. The other party lessee will directly give you the rental income. Okay, so that's actual gross amount will come to you. And recharges of operating fees. Bohai company bears all costs which occur when the lessee operates the cruise ships and recharges them to the lessee. Okay, so that means these operating fees, one is rental income, and secondly, we are operating the ship for them. So these maintenance fees, they give us directly. Now use your brain. Use your brain. In this case, no third parties involved. We are directly providing services. Just students listen. We are directly providing maintenance services to those guys. So yes, we are the principal and we are directly collecting the money. We are directly collecting the fees from them. So yes, in this case, we are principal, and this is our right to book gross revenue in our income statement. This time it's right. Now read the second paragraph. For some operational items such as fuel and food supplies, the lessee can enter into a direct purchase. The other party. We are lessors. They are talking about lessee. Read it again. For some operational items such as fuel and food supplies, the lessee can enter into a direct purchase agreement with third parties. Use your brain. At each port, but the third parties bill Bohai company directly, as Bohai company arranges the port facility. Only the port facility is arranged by Bohai company. In this specific case, Bohai company then recharges the cost to the lessee based on the lessee's consumption of goods, plus a management fee. Now look at here. This second transaction is different. What is the second transaction? We are Bohai company. Just few minutes, please. We are Bohai company. We are lessor. We have told them that you can park your ship on these 3 ports. You lessee can park ship on 3 ports. And then you can go out, and from any shops you can buy foods, and you can buy food and fuel. You can buy directly food and fuel you can buy. But we will gonna pay them. We gonna pay them. We gonna pay them, and we'll charge a certain management fee for this. We charge a certain management fee for them. Now, in this case, in this second case, just think, are we providing, are we delivering fuel? Are we delivering fuel and this food supplies? No. That party directly giving food, that party directly giving food and supplies, and food and fuel supplies, and we are just taking a management fees. So in this case, the control of that goods and services before delivering to customers, the control of that goods and services before delivering to the customer is under the control of that party, is under the control of that third party. So that third party is the principal, we are just agent. In the second case, we are just agent. That's why we are just charging the management fee, which is the commission. We are just charging the management fee, which is the commission. You are not getting. Just think over it. I told you the difference between principal and agent. If I say I am principal, so whatever I am delivering to my customer, before delivery, that thing is in my control. That goods and services, okay? And in the case of agent, if I am agent, before delivery, that thing is not in my control. So now just use your brain. In the second case, that food companies and fuel companies will directly deliver to our lessee. That means the control of that food and the control of that fuel before delivering to customer was under that party. So we are just agents. And one more indication I can give you, that we are not here to set the price. We are not here to set the price in this second contract. So we are just agent. We are just agent. And when in the second case, we are just agents, we can only book the management fee in our income statement. We can only book our commission or management fee in our income statement. But yes, in the first case, which is different. Let me tell you some description in that paragraph. See, this is connected here. For other operating costs of the cruise ship, such as engine maintenance and cleaning, engine maintenance and cleaning of the cruise ship, these are billed at a price agreed on that date when the lease is signed. See, we decided the price. We decided the price of cleaning. We decided the price of cleaning and maintenance services. So right here we are the principal. But in this mid paragraph, we are just agents. So just you have to discuss this issue. Now read the final line. Bohai company concluded that it acts as a principal in all of its dealing with the lessee and recorded all revenue gross. Sorry, you are wrong. For all these things, you are wrong. As they have said, all it's wrong. Student, did you understand? Did you find the difference? Did you got the difference between these transaction and the principal and agent thing? Please comment. Did you get the difference of principal and agent? Please comment. All of you, please comment. All of you. Now let's move. The discussion is also simple, like what I've said to you right now. See this. IFRS 16, the starting line is leases state that for a contract which contains lease, the entity should account for each lease component within the contract as lease separately from non-lease components. Yes, if you have given certain thing on lease as well as you are providing other services, so obviously these two are separate things. These two are separate things. Okay. Here, lessee has the right to use the cruise ship for a specified period of 5 years in exchange for rental fee. Yes, first thing, do you guys know the definition of lease agreement? Can anybody tell me? In IFRS 16 we teach the definition of lease agreement. The definition is how you identify the lease, how you identified the asset must be identified. The asset must be identifiable asset, and you have transferred the right of use. You have transferred the right of use in exchange of consideration. Three things: specified asset, specified asset. Number two, you have transferred the right of use, and number three, in exchange of a consideration. All these conditions are met. All these conditions are met. Yes, ship is a specified asset. Ship is a specified asset. Yes. Number two, you have transferred the right of use, and number three, you are charging the rent. So yes, it's a lease. One lease element is there. Simple. Now, Bohai company should reflect the underlying asset subject to the lease agreement in the statement of financial. Yes, this is a routine thing. Bohai company has application number 2. Bohai company has to assess whether the operating services for the cruise ship are non-lease element. Yes, these are non-lease element. Then let me tell you this issue. Can anybody tell me the stage 4 of IFRS 15? Can anybody tell me stage 4 of IFRS 15 on the comment box? Can anybody tell me stage 4 of IFRS 15 on the comment box? Yes, very good. Allocation of price. Yes, allocation of price. You have total price and you have different performance obligation. You have total price and you have different performance obligation. So you allocate the total price on different performance obligation using stand-alone prices. Remember, using stand-alone prices. So here we have the same discussion. See, for example, you have a tenant. Tenant is giving you rent. Tenant is giving you rent as well as management fees. The property in which your tenant is living. You are also managing the lift of that property. You are also managing the security issue, the water issue of that property. So now your tenant will give you two payments. One is rental and second is management fee. What if you charge a combined amount? You charge a fixed combined total amount from your tenant. So now this total amount contains both things. Now this total amount contains both things, the rental element as well as the other services. So now you need to apportion both of them using standalone prices. This is written here. Now you need to apportion both of them using standalone prices. This is written here. Read it. Now application 3. Now this is again principal and agent issue, which is the heart. Principal agent issue, which is the heart of this question. When more than one party is involved in providing goods or services to a customer, IFRS 15 requires an entity to determine whether it is a principal or agent in this transaction. Bhai, now listen. When the goods or services are provided by us as well as some other parties to the final customer, so we need to check whether we are principal or agent. Simple. Hence the operating cost of the cruise ship, such as engine maintenance, cleaning of the cruise ships, are carried out by Bohai company and are billed at a price agreed on the signing of the lease. Agreed on the signing of the lease. Therefore, Bohai company is acting as a principal, and therefore the recording of operating costs at the gross amount is correct. Yes. For the cleaning services, maintenance services, we are directly providing. We are directly providing, and we have got the control of those goods and services before the delivery. And we are here to decide the price, everything. So yes, we are principal, and the gross amount recording is correct. But in the second case, the direct, this is about food. This is about food and wait. Yes, food and fuel. You remember about that port parking? The direct purchase agreement with third parties at each port are billed to Bohai company, and the entity adds a management fee and bills the total to the lessee. The fact that Bohai company acts as an agent is only relevant for the presentation of the consideration. Listen, and not for the identification of separate component of lease contract. Now wait. What if I'm an agent? What if I'm an agent but I do the accounting of principal? What if I'm an agent but I do the accounting of principal? What will be the problem? The presentation will affect. What will affect? The presentation will affect. Let me tell you. Listen. This is principal, this is agent, wait, and this is final customer. Principal, agent, and customer. Can you see these three people? Principal, agent, customer. Can you see these three people? Let us say principal, we are selling, we are as an agent selling goods for 100 rupees. The cost is 80. The cost is how much? 80. So what is the profit? 20. What is the profit? 20. Out of this 20, 5 rupees is our commission, and remaining 15 we have to give to principal. Remaining 15 we have to give to principal. Okay. So now, what is the correct accounting? The correct accounting is that we can only book 5 rupees. We can only book 5 rupees as our income in the agent books. In the agent books, commission income of 5 rupees will only come. No other thing will come. No other thing will come. Now, what if agent is doing like this? Agent is doing like this. Sales of 100 and cost of 95. 95 is 80 plus 15. So yes, ultimately the GP will be 5. The final impact in the income statement is again 5. The final impact in the income statement of agent is again 5, but this is wrong presentation. This presentation is totally wrong. So you know the difference between principal accounting and agent accounting. If you do wrong accounting, if you do agent accounting in principal books or principal accounting in agent books, this will hurt your presentation. Your presentation will be affected. Your presentation will be affected. Just think. Yes, one student is saying your ratios will be distorted. Yes, when your sales number or cost of sales number is wrong, your ratios will also affect. So if you do mistake in principal or agent accounting, this will hurt the presentation. That's what they are saying. See, in fact, the Bohel company acts as an agent is only relevant for presentation of the consideration. Okay. Now, Bohel company should recognize revenue only in the amount of the management fees. Yes, for fuel and food. For fuel and food, we can only book the management fee, which is our commission, to which it expects to be entitled in exchange for arranging for the specified goods and services provided by the third party. In this case, Bohai company cannot control the fuel and food supply before they are transferred to the lessee. I told you, remember that in the second story, the foods and fuel are directly, the food and fuel are directly delivered. The food and fuels are directly delivered to the lessee, and our role is very limited. So we are not, we cannot even control. We cannot even control the goods before delivery. So yes, we are agents. Okay. And in the end, you can read some more lines regarding the price and risk, which I told you. Regarding the price and risk, see this. In the food and fuel, we cannot set the prices. I told you, in the food and fuel, we don't have any consumption or inventory risk. Everything they are dealing. So yes, we are just agent. Okay. I have a question. Did you understand the 80 or 70% of this part? Not 100%. My simple words. Did you understand the 70 or 80% of this? Now student, listen, make this approach. As you are students of strategic level. This is not basic level. Obviously, things are technical. So whenever you start solving any question, if you are getting 70%, 75%, this is very good. Why? In the exam, you have to score 50 marks, especially for these strategic paper. 50 is a very big super shot. It's a super shot. Passing is everything. Yes, in the second para, Buhai is an agent, and in the first para, we are the principal. For maintenance and cleaning services, we are the principal. So make this approach in your mind, that whenever you are reading any article, because there are exam article on accglobal.com, don't expect that you will understand each and everything. Never ever expect this thing. 70%, 65%, 75%, depending on your mood, depending on your energy. Sometimes you need to read 2 times or 3 times. Yes, this is normal. And the way you are studying, the same approach previous students also followed. Same approach, the same marking facility, same mock, the same terror they face, because this terror is there. And this is good, obviously, otherwise there is no value of ACCA. If there is no terror there is no fear in these papers, that means everybody can do ACCA. And if everybody can do ACCA, so how will you get the job? So you guys are precious people. Very few people do chartered accountancy. So this pressure you need to absorb. Okay, right? So best of luck for your exams. I'll send you these slides after the class. I'll send you, right? And whatever I'm sending you on the WhatsApp group, please do watch those past papers. Please do solve the mock. I have already also sent the mock to my registered students, so they can also solve it and send it to me before the due date. There is a due date of mock solving, right? Okay, so goodbye and take care.